system overall. Pranav Gundlapalle, Senior Analyst, India Financials at Bernstein, is with us now. Pranav, great to have you on. So, is there any sensitivity analysis or any sort of analysis around who benefits the most with this over, 1 trillion rupees that comes into the system with this 50 basis CRR cut? What are your first thoughts?
Right, so I think there are two parts of the benefits. Right? One is to the stock, which is you have banks which will see some improvement in their NIMs, maybe about 3 to 4 basis points, because you need to keep lesser amount with the central bank now. I think the second is the set is more on the flow basis, where the banks which were constrained on liquidity for their growth will stand to benefit a lot more. So in that sense, the public sector banks, which were nearing the end in terms of their excess liquidity, will probably see a bigger relief compared to the private sector banks.
Okay. That's interesting. So that's the first relation or the first order analysis that in general, PSU banks will probably see a greater relief. They've also had a great run, Pranav. I mean, in terms of just the stock price action, right? PSU banks have really come back in a big way. Do you like any names here?
I think at this stage, they're largely, I think most of the upside is priced in. We do like SBI, but we think it's fairly valued at this stage. So you can sit there for the compounding story to play out. But from a re-rating perspective, we don't see a lot of room left. And while, yes, the CRR gives a bit more of the runway, we think the loan growth for the public sector banks will eventually be constrained by their deposit growth, where there is still a very wide gap between the public and the private sector banks on the deposit growth, which we think will flow into the loan growth as well. And when that happens, it's hard to see a re-rating in that event.
Got that. Pranav, good morning. Prashant here. In terms of your sort of coverage universe, Pranav, how would you rate what is looking very attractive, what is looking sort of out of what you wouldn't want to do anything with right now? Not just banks, but NBFCs and anything else you cover from the financial space.
Right. We find HDFC to be attractive. We think there will be an ROA improvement story, which will be counter to what most of its peers would be seeing. And given that we will see it coming back to EPS growth in somewhere in the mid-teens levels, and maybe 12 months out, loan growth also catching up to be ahead of the system, I do see a re-rating potential there, and hence that's our top pick. The ones we would stay away from at this stage is the consumer-focused NBFCs, the likes of SBI Cards, Bajaj Finance. We think we still have a couple of quarters more of pain left in terms of asset quality. Now that most of the lenders have toned down their lending in the consumer segments, we think it will have a ripple effect in terms of asset quality. We would wait for that to play out before jumping into any of these names. So that's the setup we would stay out. We also like Paytm more as a way to play, apart from the longer-term payment story. We think it would be one way to play a rebound in consumer lending when it happens a few quarters down, without the concerns around the asset quality front. So those would be the kind of areas we like and the ones we would stay away from.
Okay. By the way, those are some numbers coming in from FADA. Auto numbers are looking okay. 11-12% growth for the month gone by. And that's largely thanks to the fact that two-wheeler sales are holding up and SUV sales are holding up, because otherwise CVs is a painful story, as are passenger vehicles. The reason you're seeing that sharp drop on the passenger vehicle number is that it's a typical seasonal impact. Post-festive season, I mean, the demand gets bunched up between Dussehra and Diwali in most years. So immediately after that, there is a drawdown in terms of appetite and demand. We'll watch out for how these stocks behave and react. Pranav, finally, now, this whole MFI business, right? And this is something that you alluded to in your post-earnings note as well. The stress is real for a lot of these entities, and some of them are being called out by rating agencies for delay in bond payments, etc. I remember Spandana Spurti, I think, last week was called out. What are you factoring in as of now? A recovery in Q4 as what a lot of managements are guiding for, or could this be more painful? What's your overall stance and thesis on NBFCs, specifically consumer lending and MFI?
Right. See, I think MFI being a shorter tenure loan would typically recover faster than the consumer, the overall consumer segment. So we would expect some sort of a recovery, or at least bottoming out of credit costs by Q4 or Q1 of FY26. That's one. I think the second is what happens in the longer term. We do expect them to get past the credit cost pain, but we do think the growth would be a lot more moderate going ahead compared to what we had in the last few years. So what we are baking in is, yes, a recovery in the first quarter of next year, but a lot slower growth and also a lower ROAs, given that there are going to be more restrictions around leveraging and what they can do in terms of their lending business. So slower growth, lower ROA will probably be the new normal, but the worst of credit cost should be over by Q4 or Q1 of next year.
Okay. All right, Pranav, we'll leave it on that note for this morning. Thank you very much for joining in. Good to have that person.